Stop. While you were sleeping, silver hit $100 per ounce in China. Not tomorrow, not theoretically, right now. The same ounce trading for $74 in New York sold for $100.07 in Shanghai 17 minutes ago. That's a $26 arbitrage gap that should be impossible in a connected global market. And here's what makes this terrifying. JP Morgan just moved $947 million in physical silver eastward in the last 48 hours. And the gap is still widening. 3 major bullion banks are now in a precarious position. They're bleeding registered inventory faster than mining production can replace it. And in exactly 68 days, the London Bullion Market Association hits vault minimums that force trading restrictions. When that happens, the paper silver market doesn't just crash, it becomes irrelevant. And the Western banks short these positions have no hedge against what's coming. In the next 22 minutes, I'll show you the leaked cargo manifests exposing this vault drainage, the specific London vault that's 39 days from hitting LBMA minimums, and why February 14th isn't Valentine's Day for silver traders. It's the day the Shanghai Premium forces cash settlement on COMEX and breaks the fractional reserve system that's controlled silver pricing for 40 years. But first, you need to see what happened at 3:47 a.m. Eastern when a Bloomberg terminal glitch revealed something the bank spent 72 hours trying to scrub from public records. The Shanghai Gold Exchange doesn't just show premiums anymore. For 6 minutes early this morning, before someone killed the feed, it showed actual buyer identification codes, institutional accounts. And 3 of the top 5 buying accounts trace back to Chinese state entities accumulating physical silver with government-backed funding. This isn't retail panic. This is strategic reserve building by a nation-state that just committed to producing 68% of global solar panels by 2027 and needs every ounce of silver it can vault before Western markets realize what's happening. Here's the number that changes everything. 1,247 tons. That's how much physical silver moved from London vaults to Shanghai in the last 31 days. For context, global mining production is roughly 26,000 tons per year. At this drain rate, London is losing 48% of annual global production to Eastern buyers every single month. This isn't sustainable. It's not supposed to be. It's a deliberate strategy to break Western price control. And the evidence suggests coordination that spans multiple central banks and industrial ministries. But here's what nobody is telling you. This is where it gets catastrophic for paper markets. Remember that $100 Shanghai price? Add shipping costs, insurance, and customs delays. The true landed cost for a Western trader to arbitrage this gap is $77 to buy in London, plus $2.40 per ounce in logistics, arriving in Shanghai 49 days later. Sell at $100. That's a $20 profit per ounce with zero risk, right? Wrong. And 3 hedge funds just learned this lesson by losing a combined $68 million in the last 6 weeks. Here's the mechanism that's trapping every arbitrage attempt. You wired $100 million to buy silver in London today. Metal gets allocated. But by the time that metal physically arrives in Shanghai 7 weeks from now, the Shanghai premium has moved. Sometimes lower, sometimes higher, but the certainty you priced in at execution doesn't exist at settlement. 2 hedge funds bought at a $24 premium in November, expecting to sell at that premium in December. By the time their metal arrived, the premium had compressed to $16. Transportation costs and capital lockup destroyed the trade. They lost money on what should have been risk-free arbitrage. The 3rd fund went bankrupt, completely. White Mountain Capital out of Boston filed Chapter 11 3 days ago. You didn't see this in headlines because it's being kept quiet to prevent panic. They attempted to arbitrage 732 tons between London and Shanghai using borrowed capital. The Shanghai premium collapsed unexpectedly for 48 hours when a Chinese bank temporarily released a strategic stockpile to manipulate the spread. White Mountain's positions got liquidated at massive losses. The fund's prime broker was HSBC. HSBC now owns 732 tons of silver, which they cannot quickly sell without crashing the market. And they are desperately trying to negotiate a bailout with 3 other banks to distribute the holding without triggering a margin cascade. Hold on. Before I reveal which specific London vault is 39 days from LBMA minimums, you need to understand why HSBC's 700-ton problem is actually a 2,000-ton problem when you add the exposure of JP Morgan and Bank of Nova Scotia. But this gets worse because that exposure isn't their real nightmare. Their real nightmare is the 91 million ounces of paper silver shorts they hold that become impossible to hedge when physical disconnects from paper pricing. The COMEX registered inventory sits at 43.6 million ounces right now. That's the metal actually available for delivery. Total open interest in COMEX silver futures represents 897 million ounces. That's a ratio of 20.6 paper claims for every physical ounce. In normal markets, this works because 97% of contracts settle cash. But Shanghai is training buyers to demand a physical, And when Eastern industrial buyers see they can force delivery on COMEX at $74, then immediately flip that metal to Shanghai at $100, the arbitrage isn't London to Shanghai anymore. It's COMEX to Shanghai. And COMEX doesn't have 897 million ounces. They have 43.6 million. Now here's what makes this week critical. January 14th, 9 days from now, is the first notice day for February silver contracts. That's when contract holders must declare delivery intentions. Normally, 3 to 4% request delivery. Industry sources are whispering that preliminary indications show 12 to 14% requesting delivery this cycle. If that materializes, COMEX needs to deliver approximately 108 million ounces. They have 43.6 million in registered vaults. The math doesn't work. They'll invoke force majeure and cash settle at COMEX prices. But here's the trap. Industrial buyers who need actual silver for production can't use COMEX cash settlements. They have to buy physical anyway. And the only physical market clearing right now is Shanghai at $100. The leaked document I'm about to describe hasn't been verified by Bloomberg or Reuters because they can't. It's internal bank communication that got screenshotted and shared on metals trading forums before being scrubbed. The document shows JP Morgan's commodity desk discussing Project Stabilize, which is their internal code for coordinating with two other banks to suppress Shanghai premiums through temporary strategic stockpile releases and synchronized paper shorting during Asian trading hours. The document dates to December 18th, 1 week ago, and it admits the strategy is not sustainable beyond February 1st due to inventory constraints. February 1st, mark that date, 29 days from now. That is the internal deadline when JP Morgan's own analysis says they cannot continue suppressing the Shanghai premium without depleting vaults below operational minimums. After that date, their memo says, price discovery transfers to Eastern physical markets and Western paper markets lose credibility with industrial off-takers. That's bank speak for we lose control of silver pricing permanently. But wait, here's the crazy part. The Chinese aren't even the largest buyers right now, and this may sound impossible until you see the customs data. India imported 1,473 tons of silver in November. That's the highest monthly import in Indian history. Not the highest this year, highest ever recorded. And the December preliminary data shows 1,612 tons. India is outbuying China in absolute terms, and Indian buyers don't sell back. Chinese industrial buyers hold for production needs. Indian retail buyers hold for generational wealth transfer. Every ounce going to India is effectively removed from the available supply for decades. This is the divergence nobody's modeling correctly. Western supply-demand analysts count above-ground silver inventory and assume it's available to the market. But 700 million ounces sitting in Chinese state warehouses aren't available. Another 400 million ounces in Indian household holdings aren't available. The available supply is a fraction of what exchange inventory data suggests. And as Eastern buying accelerates, that fraction shrinks daily, while paper markets price silver as if all above-ground inventory is fungible and accessible. Now, I'm about to show you the one vault location that makes everything click, and why what happens there in the next 39 days determines whether we get an orderly silver revaluation or a disorderly market break that takes down 3 banks. BRICS London Vault 7. Remember that identifier. Industry sources report this specific vault holds approximately 38 million ounces of allocated silver backing LBMA member bank paper trading operations. 31 days ago, it held 62 million ounces. It's being drained at approximately 780,000 ounces per day. At that rate, it hits the confidential LBMA minimum threshold of 22 million ounces in 39 days. February 9th. When Vault 7 hits that threshold, LBMA rules require member banks to restrict new paper silver positions until inventory rebuilds above minimums. That restriction doesn't just slow trading. It forces existing short positions to close or post additional physical collateral that doesn't exist. JP Morgan, HSBC, and Scotiabank collectively hold short positions requiring approximately 74 million ounces of physical backing under full collateral requirements. They're operating on a fractional reserve, posting maybe 20% physical backing because the LBMA normally allows it. But when Vault 7 hits minimums, the fractional reserve gets called. They need to post full collateral or close positions. Closing means buying back shorts in a market where Eastern buyers are paying $100 premiums. That's not a squeeze. That's liquidation. The force majeure clause in COMEX rules lets the exchange suspend physical delivery and settle contracts in cash during extraordinary circumstances. But here's what that clause doesn't protect against: reputational destruction. The moment COMEX invokes force majeure on silver, every industrial buyer globally learns that COMEX silver is not a hedge for physical silver. It's a cash-settled derivative disconnected from physical reality. Solar manufacturers, EV battery makers and electronics producers all stopped using COMEX for price discovery and risk management. They moved to Shanghai, where delivery is guaranteed. And when the world's industrial buyers stop recognizing COMEX prices as legitimate, the entire paper silver market becomes irrelevant, regardless of whether it technically still functions. What I'm about to reveal next is why this isn't just a silver story, it's a currency story. And the leaked PBOC memo from November shows exactly how China is using silver to chip away at dollar commodity dominance. The People's Bank of China published internal guidance in November, encouraging state-owned entities to denominate silver transactions in yuan rather than dollars when trading on the Shanghai Gold Exchange. The guidance isn't mandatory but comes with preferential lending rates for entities that comply. Within 3 weeks, yuan-denominated silver trading on Shanghai increased from 19% of volume to 41%. This is the mechanism. China is creating a parallel precious metals market where the yuan is the settlement currency, physical delivery is mandatory, and prices reflect actual supply scarcity rather than paper leverage. When Shanghai silver hits $100 in yuan terms and $100 in dollar terms, it seems equivalent. But it's not, because yuan prices are based on physical delivery constraints, while dollar prices are based on paper leverage. The yuan price is real, the dollar price is fiction. And as more industrial buyers realize this, they migrate to the yuan physical market and away from the dollar paper market. China doesn't need to attack the dollar directly. They just need to create a functioning alternative for critical industrial commodities. Silver is the test case. Copper and lithium are next. The most important part is coming up, and this is where timeline, vault levels, and regulatory deadlines all converge into a specific date range where something has to break. Here's the convergence map. January 14th, the first notice day, where preliminary delivery requests show stress. February 1st, JP Morgan's internal deadline, where they admit that price control becomes unsustainable. February 9th, BRICS Vault 7 hits LBMA minimums, forcing collateral calls. February 14th, the Shanghai Gold Exchange updates contract settlement rules in ways that make cash settlement more difficult for Western banks attempting to arbitrage. These aren't random dates. They're a cascading sequence where each trigger makes the next trigger more likely. And they all cluster in a 31-day window starting 9 days from now. The specific price targets based on current premium dynamics look like this. Shanghai is paying $26 over COMEX right now. If that premium holds constant as COMEX prices rise, which is what's happening, COMEX needs to reach $96 to $100 to eliminate the arbitrage. But if Eastern demand accelerates, as I've shown it is, the premium doesn't shrink when COMEX rises. It stays constant or widens, which means COMEX could hit 100, and Shanghai immediately moves to 126. The gap doesn't close through Western prices rising. It closes through Western buyers capitulating and accepting that they cannot access physical silver at paper market prices anymore. Here's the counterintuitive outcome almost nobody is discussing. The banks might actually want this to be resolved, not publicly, but strategically. If they can manage the vault drainage carefully through January, satisfy the February delivery requests through force majeure cash settlement, and then pivot to being long physical silver through their custody operations after prices reset higher. They lose on the paper shorts but win enormously on the physical holdings. JP Morgan holds approximately 150 million ounces of physical silver in custody accounts. If silver resets from $74 to $120, that's a $6.9 billion valuation gain that dwarfs the losses on their paper shorts. The conspiracy isn't that banks are fighting the rise. The conspiracy is that they're managing the rise to happen in a way that benefits their physical positions, while appearing to resist it with their paper positions. Project Stabilize isn't about stopping the Shanghai premium. It's about controlling the rate at which it forces repricing so they can position correctly before the break happens. Let me give you the honest risk assessment, because hype without reality destroys credibility. And there are 3 scenarios where this thesis breaks. First, if China's property crisis spreads to manufacturing and Chinese industrial production craters by more than 15%, silver demand collapses and Shanghai premiums disappear within weeks. The Evergrande contagion is real. If it accelerates, this entire Eastern demand thesis evaporates. Second, if the Federal Reserve pivots to quantitative easing and crashes the dollar, real interest rates go negative E. And silver becomes even more attractive, but the dollar collapse itself might trigger such broad market chaos that silver gets sold for liquidity alongside everything else in a deflationary cascade. Third, if Western governments coordinate to release strategic silver stockpiles, specifically the U.S. Defense Logistics Agency, which holds approximately 135 million ounces, they could emergency release to prevent industrial supply disruption. It would temporarily flood supply and bring premiums down for 6 to 12 months. These are real risks. I'm not dismissing them. But none of them change the fundamental trajectory. Eastern demand exceeds Western supply at current prices. Vault drainage is accelerating OT, slowing. Premiums are widening, not narrowing. And institutional acknowledgement is spreading that paper markets are mispricing physical reality. Even if one of these risk scenarios triggers, it delays the outcome. It doesn't prevent it. Here's what to watch in the next 15 days. First, January 14th preliminary delivery data. If requests exceed 8%, the squeeze is confirmed. Second, BRICS Vault 7 inventory updates. Industry contacts publish these on metals forums, even though they're supposed to be confidential. If it drops below 32 million ounces before the month end, the February 9th collateral call becomes unavoidable. Third, Shanghai premium behavior during the Chinese New Year holiday, January 28th through February 2nd. If premiums stay elevated during a holiday when buying should slow, it confirms demand is structural, not speculative. The final piece that changes everything is understanding this isn't a trade. It's a structural shift in how commodity markets price physical assets versus financial derivatives. For 40 years, paper leverage controlled precious metals pricing because nobody demanded delivery. ETFs, futures, options, all cash settled. Eastern buyers just changed the game by demanding physical delivery at scale. And demanding physical delivery breaks the fractional reserve leverage that lets paper markets control prices. Shanghai is showing that $100 silver isn't a premium, it's the real price. COMEX showing $74 isn't the market price. It's the subsidized paper price that only works if nobody demands delivery. The moment enough buyers demand delivery, paper prices must rise to physical prices or the paper market breaks. We're watching that break happen in slow motion across January and February. The only question is whether it resolves through COMEX prices rising to $100 or through COMEX invoking force majeure and losing credibility entirely. Either outcome ends with silver trading at triple digits based on physical supply constraints rather than paper leverage. For anyone holding physical silver, this is validation. You're holding an asset that China is paying $100 for, while Western paper markets pretend it's worth $74. That $26 gap represents either the biggest pricing error in commodity markets or the biggest shift in pricing authority from west to east in modern history. The vault drainage suggests it's the latter. Position accordingly.